Hi, this is your interest rate watch for Tuesday, October the 26th. Pretty much this is breaking news that we want to bring to you. Right now, with what's going on with the Federal Reserve, there has been a significant change in stance from both, I wouldn't say it's the economists, but from media. Media is now really starting to pick up on what the economists have been forewarning as far as the fear of inflation. And with the unfortunate bad auction results of the what they call 5-year tips, or what they call treasuries in the bond market, that's really showing signs of where the future of inflation could lead us and what the real concerns here are. Now, the big concern is coming up in the November 3rd meeting. We've been talking about how deflation could play in the role of them printing off basically more money to purchase these bonds, purchase this buyback program, which they did in 2009. Now, on the opposite side of this, what now has become the concern is how this is going to affect inflation. And it's become so much of a concern now, just within the last 24 to 48 hours, that now they're starting to fear that because of the fears of inflation coming, it may not have the results that was originally intended to bring interest rates lower. In fact, we may only see what we saw in 2009 as far as stabilizing interest rates. Now, what this really could lead to is a very bumpy road. Should the market not react well to this whole plan on the November 3rd the Federal Reserve is planning to bring out, it could totally react oppositely and actually send mortgage rates higher. Now, we have seen this happen where we've seen a knee-jerk reaction. It spiked higher, it then did trickle back down, we hit some low points, and then it moved back up again. Is this something we could see? Well, if we're looking at what's coming across the media board and what Wall Street is saying, this very well could happen. So we want to forewarn that even though we're going to have to bite the bullet here and say we were thinking also the same as the market, that interest rates could get pushed lower, that based on what this breaking news is coming out, we would have to say that we're going to go into agreement with the inflationary concerns and with what happened with the auction, that if the market receives that the Federal Reserve is printing off too much money and the fears of inflation do return over the sense of deflation, which seems to have stabilized now, then the biggest concern is how that's going to impact interest rates. Now, keep in mind, if you go back to 2003, right after the last big economic turnout that we had with the dot-com bust, going back to that period of time, what we really did see at that time is interest rates move up quite rapidly. And in fact, within almost a 24 to, I would say, about a 28-month period, we did see the prime rate go from the 4% range all the way back up to 8%. Now, that is a short period of time, and with the amount of money that the Federal Reserve is putting into the economy, in putting in out there to purchase these types of bonds and securities, we could see that move just at a little bit faster pace. No one really knows, but here again, if you do have a second mortgage, we are putting out the explicit concern that right now it is the time to try to get that wrapped up. If you cannot get that combined because of equity reasons, and you cannot combine your first and second mortgage together, then also take consideration of turning that current home equity line of credit into a fixed rate once the signs of inflation do return, because that's going to push those home equity lines of credit up higher. The other thing to consider too is mortgage insurance has always been the thorn in the side of homeowners. People have always thought, mortgage insurance, I don't want to have it, I have equity. Well, here's something to consider. If you have a first mortgage at 80% of your current value, of today's value in the marketplace, and you have a second mortgage that takes you up to 90%, there is a possibility that you can do a refinance, combine those into one, and unfortunately, if you did have to pay mortgage insurance, here's what we're going to forewarn you on. If you can capture an interest rate at 4.25% today and have both mortgages into one, even though you have mortgage insurance, we want to pose this question to you. If that interest rate on that second mortgage as a variable line of credit was 8%, and you had a 4% fixed rate mortgage today, and then comparing it to a mortgage that was all in one with a mortgage insurance, we can almost guarantee that if by combining into one and paying mortgage insurance, your payment would be less today than it would be if that second mortgage on that adjustable rate mortgage on the second went to 8%. So we'll put up some Q&A facts. We'll do a slideshow on this to make it really clear. But we are forewarning on this, and we're going to take the stance that if you do talk to a CPA or financial analyst, they're going to back us on what we're saying, because it's very important right now. With the fears of inflation that do start to lurk, media is going to pay attention to it, and as media pays attention to it, the first signs of inflation concerns that do return when the economy does start to grow, that is going to spike the interest rate. So we're forewarning right now that the November 3rd could react almost negatively to the bond market. Any breaking news, make sure to follow us on our Twitter and Facebook fan page, and we'll talk to you real soon.